You know, I love Roth IRA account, but that's not my number one tax advantage account. My number one is HSA account because that is the only tax advantage account that provides triple tax benefit. So today I'm going to talk about HSA and its tax benefits and how it works. So I want to start with the triple tax benefit. So tax benefit number one, you get to take a tax deduction when you make a contribution to your HSA account, which acts like a traditional IRA. Tax benefit number two is the tax deferred growth within the HSA account, which works like a Roth IRA. And tax benefit number three is tax-free withdrawal, like a Roth IRA. So essentially, HSA has a tax advantage of both traditional IRA and Roth IRA. That's why I think is something that anyone who is eligible to open a HSA account should consider opening it and contributing to it every year. So let's talk about what HSA is and what it is for. So HSA stands for Health Savings Account, which is an account that allows you to pay your healthcare related expenses with tax-free money. So no matter who you are, you'll eventually incur some healthcare related expenses at some point in your lifetime. Right? So might as well pay with the tax-free money. So you can use pre-tax HSA money to pay for an array of healthcare related expenses tax-free. So just to name a few, you can pay for qualified long-term care expenses, qualified long-term care premiums, and even healthcare coverage while you're unemployed, alcohol drug treatments, and weight loss programs, smoking cessation. The list goes on and on and on. So how much can you contribute to an HSA in an account? So the maximum that you can contribute depends on whether you're single or have a family. So if you're single, you can contribute roughly up to $4,000. If you have a family, the limit doubles to about $8,000. If you're over 50, then you can contribute an additional $1,000. Unlike a Roth IRA, HSA contributions are not limited by your income. You can make $1 million a year and still make a contribution to your HSA account and take a tax deduction. So it is a wonderful, amazing option for high income earners. While you can contribute money to your own HSA account, there are other three ways to pump your HSA account up. So first way is your family. Even if you're not making any money, your family members can contribute money to your HSA. But what's crazy? You still can get a tax deduction. So instead of asking for a Christmas present, ask your grandpa to fund your HSA. The second additional way to contribute to your HSA is your employer. So your employer can make a contribution to your HSA account and you won't have to pay tax on that amount. Wonderful. So third way is through your IRA account. So essentially, you can transfer money from your IRA account to your HSA account, but you can only do that once in your lifetime. And the maximum amount that you can transfer is same as your annual HSA limit. So it's gonna be either $4,000 or $8,000, roughly. So this method of contributing to your HSA would be extra beneficial if you contributed money to your traditional IRA during your residency. By transferring money out of traditional IRA, you can clear pre-tax money so that you can do a backdoor Roth without needing to deal with the pro rata rule or cream in the coffee rule, which I'll delve into deeper in another episode. So one caution that I'd like to share is that no matter who funds your IRA HSA account, the total amount that can be contributed to your account a year is still limited by your maximum HSA contribution amount based on you're single or have a family. So $4,000 or $8,000. So make sure that you keep track of the flow of money into your HSA account so that you can ensure that the total does not exceed the limit, because 6% excise tax will be imposed on the excess contribution amount. And don't forget, HSA money has to be used for healthcare related expenses, and 20% penalty will be assessed on the money that's been pulled out of your HSA, and they're used for non-qualifying expenses such as to buy a car or a house. An exception to this rule is if you're older than 65, disabled, or have died, then 20% penalty can be waived, but taxes will have to be paid on the amount withdrawn. Hope this was therapeutic, and I hope you guys see you at the next tax clinic.